All right, let's unpack this. Have you ever found yourself nodding along to business news, but secretly wishing someone would just break down what's really going on?
Yeah, like what actually makes a company tick?
Exactly. What makes them valuable? How do they predict the next big disruption? And honestly, what on earth is governmental accounting?
Right. It sounds so
If you've
different.
ever felt like the world of business, finance, and strategy is maybe a fascinating puzzle, but, with a few missing pieces, well, you are in for a treat today.
That's absolutely right. Today, we're really aiming to cut through the noise. We've got a fantastic stack of sources here, covering everything from core enterprise risk management
Okay.
to market dynamics, financial valuation, and even those unique rules of government finance.
Well, quite a range.
Yeah, our goal is really to give you a shortcut to truly being well-informed. We want to pull out those aha moments that make these complex topics finally click.
Okay, so our mission in this deep dive is to explore the fundamental pillars holding up the modern business landscape. We'll show you not just what these concepts are, but really why they matter.
Hmm.
We'll use clear analogies, maybe some surprising insights from the material you've provided. So let's get started. Where do we begin?
The bedrock of business, value, risk, and strategy.
Well, I think we have to start with the absolute core, right? Value.
Value. Okay.
Every successful business, at its heart, is about creating something invaluable. It really comes down to this idea of value.
So how do we define that? Is it just profit?
Not quite. It's broader. We're talking about how a company generates benefits, real benefits, that consistently outweigh the costs of the resources it uses.
Ah, okay. So resources like people, capital.
Exactly. People, capital, technology, even the power of its brand. When the benefits exceed those costs, you're creating value. It's fundamentally the reason businesses exist.
Okay, that makes sense.
And here's where it gets really interesting. The definition of value, well, it isn't one size fits all.
Ah, right. Depends on the organization.
Precisely. For a standard for-profit company, value is directly linked to balancing market opportunities against the risks involved in chasing those opportunities.
Makes sense. Risk versus reward.
But if you look at a not-for-profit or, say, a government entity, value shifts,
Hmm.
becomes more about delivering essential goods and services to the community,
Mm-hmm.
again, balanced against those associated risks. So ultimately, every single decision management makes, from the big strategic plays down to daily operations, directly impacts whether value is created, preserved,
Or even eroded.
yeah, or fully realized. It's like this constant balancing act.
Speaking of balancing acts, every organization, big or small, faces risks, right? Things that could just derail its objectives.
Absolutely. And that's where enterprise risk management, or ERM, steps in.
Okay, ERM, it's not just about avoiding problems, is it?
No, not at all. It's much more proactive. It's a systematic framework designed to help an organization actually achieve its goals. It provides let's call it a reasonable expectation of success.
Reasonable expectation. I like that. Not a guarantee then.
Definitely not a guarantee, because, absolute certainty in business, that's a myth.
True.
What's truly fascinating, though, is how an organization's fundamental attitude towards risk, its risk appetite, actually molds its core mission and vision.
How so? Give me an example.
Okay, think about it. A bold tech startup. They might embrace risk, see it as fuel for innovation, right? That leads to rapid, maybe volatile growth.
Yeah, high risk, high reward.
Exactly. Meanwhile, a conservative utility company probably prioritizes stability, consistent service. They'll meticulously manage risks to ensure reliable operations. Their core missions directly reflect these different risk appetites.
And ERM helps them manage that specific level of risk they're comfortable with.
Precisely. It helps them measure and manage the sort of composite risk they take on.
That makes so much sense. It's like a lender deciding on an interest rate for a loan.
Yeah.
They're factoring in risks, right? Like the borrower defaulting or maybe purchasing power risk inflation, eating away at the value of the repayment over time.
Mm-hmm. Inflation risk?
And the longer the loan term, the more those combined risks pile up, and you see that reflected directly in a higher interest rate.
That's a perfect analogy. It's risk influencing cost, clear as day.
So how do organizations actually do ERM? How do they put it into practice?
Well, the performance component of ERM is really where the rubber meets the road.
Okay.
It involves identifying and carefully assessing all the risks that could possibly impact the entity's strategy and objectives.
All of them. That sounds like a lot.
It can be. These risks are then prioritized, usually based on their severity, and then weighed against the organization's stated risk appetite.
Yeah.
How much risk they're truly willing and able to take. From there, appropriate responses are chosen. Avoid, accept, reduce, share, and performance is continuously monitored. This gives leaders a really comprehensive portfolio view of all the risks the organization has assumed. Helps them make informed choices.
And it's definitely not a set it and forget it kind of thing, I imagine.
Oh, absolutely not. The review and revision element is crucial. It means continuously evaluating strategies because the business environment is always shifting.
Constantly changing.
Right. Companies need to assess substantial changes, maybe internal things like a new CEO or a major innovation, or external stuff like shifts in regulations or competitor moves. This constant reassessment ensures their objectives stay relevant and their ERM is continuously improving. It's like regularly updating your GPS while you're driving. You need the latest info.
Good analogy. What else is involved?
Another really crucial layer is information, communication, and reporting. This isn't just a separate step. It's an ongoing, iterative thread woven throughout the entire ERM process.
Okay, so communication is key.
Absolutely vital. Management uses both internal and external information, leveraging robust systems to capture and process data. Then clear communication is needed for all stakeholders, internal teams, the board of directors, even external parties like investors or regulators.
And what are they communicating? Just the risks.
It's more than that. It involves reporting not just on performance, but on that delicate relationship among risk, the organization's culture, and its performance. They're all interconnected.
This even includes things like ESG risks, right? Environmental, social, governance.
Yes, definitely. That's becoming increasingly important. For instance, you'll see climate-related reports outlining how these risks are overseen, how climate risk processes are integrated, what plans are in place to reduce those risks, and even specific metrics like greenhouse gas emissions. It's all about providing transparent, informed insights into a company's broader impact and responsibilities.
Got it. Now, what about the people making the decisions? Do they all view risk the same way?
Good question. No, definitely not. Just like people in general, different managers have different attitudes toward risk.
Okay.
Most managers, in practice, tend to be risk-averse,
Meaning
they'll require a higher expected return to compensate them for taking on greater risk. It's the most common and often, the most prudent behavior.
makes sense. Play it safe unless the reward is high enough.
Exactly. But then you also have risk in different individuals. For them, the level of risk doesn't actually change their required rate of return. It's unusual.
And the third type.
Even more surprising, some are risk-seeking. These folks are actually willing to settle for lower expected returns as risk increases. They almost seem to thrive on the gamble.
Wow. So for you, the listener, think about how these varying risk preferences might play out in a leadership team, It could influence everything from investment decisions to the whole strategic direction. It's a really powerful, often unseen force.
Definitely something to consider.
External forces and strategic responses.
Okay, let's shift our gaze outward now to the powerful external forces that constantly shape businesses. Ever wonder why the price of, your favorite coffee or maybe a new smartphone keeps changing?
Yeah, it seems random sometimes.
It often boils down to the fundamental laws of supply and demand. Generally speaking, demand for a product goes down as its price goes up, right? That's an inverse relationship.
Makes sense.
Conversely, supply typically goes up as the price goes up. That's a positive relationship. Producers want to sell more when they can get a higher price.
Right. But what's truly fascinating here is how factors beyond just the price tag can cause these entire curves, the demand curve or the supply curve, to shift.
Okay, like what?
Well, for demand, imagine a sudden boost in consumer income across a community. Maybe a big new factory opens up.
Right, more money to spend.
Exactly. That shifts the entire demand curve to the right, meaning people want more of the product at every price point. Or think about consumer expectations if you expect gas prices to jump next week.
You fill up your tank today.
Precisely. That increases immediate demand, shifting the curve. For supply, it could be things like rising production costs, making it more expensive to produce, or maybe new, more efficient technology, making it cheaper.
So these curves are always moving around.
They can be, yeah. And where these shifting curves eventually meet, that's the equilibrium price and quantity. That's the magical market clearing point where supply perfectly equals demand.
But sometimes the government steps into this delicate balance, doesn't it?
Oh, yes. Price controls are a classic example. Price ceilings, like maybe rent control on apartments, are set below the natural equilibrium price.
And what happens then?
Well, it creates a situation where demand, lots of people wanting cheap apartments, far outstrips the supply landlords are willing to offer at that low price. Result, frustrating shortages.
I've seen that. And the opposite, price floors.
Right. Price floors, like minimum wage laws, are set above the equilibrium. This can cause surpluses because the quantity supplied, in this case labor, exceeds the quantity demanded by employers at that higher mandated wage.
So direct intervention with real, sometimes unintended consequences.
Definitely. It brings up an important related question. How sensitive are demand and supply to these price changes?
Ah, elasticity.
Exactly. That's what elasticity measures. If a product has many easy substitutes, think about a specific brand of soda with a dozen competitors right next to it.
Yeah, easy to switch.
Its demand is usually more elastic. This means even a small change in price will cause a relatively large swing in the quantity people demand.
Okay, so if you're a business selling an elastic product, raising your price is risky.
Very risky. Raising your price likely means your total revenue will actually decrease because customers will just easily switch to a competitor.
But what if it's inelastic?
Right. If your product is inelastic, like maybe a life-saving medication with few or no alternatives, your total revenue might actually increase with a price hike. People still need it, and they have limited choices.
This explains so much about pricing strategies you see.
It really does. And we also look at things like cross-elasticity. That measures how the price of one good affects the demand for another good. For instance, if the price of steak sauce decreases, the demand for steak might increase. They're complementary goods.
I see. Like printers and ink cartridges.
Perfect example. And income elasticity tells us how changes in consumer income affect demand, revealing if a good is seen as a necessity or maybe more of a luxury.
Okay, let's talk about something everyone feels. Inflation. The silent tax, as you called it.
Yeah, it's that gradual erosion of purchasing power. It affects literally everything.
So if you're just holding on to cash, or maybe accounts receivable money owed to you,
Inflation is quietly hurting you. Those fixed dollar amounts will simply buy less in the future.
but here's the kicker I found interesting. If you have fixed rate debt, like a mortgage,
You actually benefit in a way because you're repaying that debt with cheaper inflated dollars down the road. It's a weird kind of financial alchemy.
it feels counterintuitive.
It does. But if we connect this to the bigger picture, inflation can significantly impact investments too. The real value of payments from fixed-rate debt, like bonds, diminishes over time. Even dividends from stocks can lose purchasing power unless the company increases them to match rising prices. And for companies themselves, inflation means production costs, labor, materials soar.
So they have to raise their own prices.
They often have to just to maintain their profit margins. Consider this. If a company's labor costs are, say, $28 million today, and inflation averages just 2% per year, which isn't huge in 10 years, those same labor costs for the same work will be over $34 million.
Wow, that's a huge hidden cost building up.
It really is.
So with all these dynamic market forces swirling around supply, demand, inflation, competition, how do companies actually chart their course? How do they navigate?
They use strategic tools. One of the most fundamental is SWOT analysis.
SWOT. Strengths, weaknesses.
Strengths, weaknesses, opportunities, and threats. It's a fantastic framework. You look internally at your company's strengths and weaknesses, and then you look externally at the opportunities and threats in the market environment.
Like taking a strategic snapshot of where you stand.
Exactly. It helps you understand your competitive landscape.
Which leads us to ask, what truly gives a company a competitive edge in its industry? Is it just one thing?
Rarely just one thing. Several factors usually come into play. Think about barriers to market entry, things that make it hard for new competitors to jump in.
Like patents. Or maybe needing huge factories.
Precisely. Patents, massive economies of scale where bigger is much cheaper, or even strict trade barriers can protect existing players. The intensity of competition within the market also matters. Is it a brutal fight with constant R&D and marketing wars, or a more stable, mature market?
Okay, what else?
The availability of substitute products is huge. If there are lots of easy substitutes, it puts a cap on how high you can price your own product. And don't forget the bargaining power of both your customers and your suppliers. If your customers have lots of choices, they have power. If you rely on one key supplier, they have power.
It's a complex web.
It is. And strategy isn't just about if you compete, but how you compete. What's your angle?
You mean like being the cheapest?
That's one way. Cost leadership, like toys-only company aiming for the absolute lowest prices to attract the mass market. This works really well when customers are primarily price sensitive.
Or you could be different.
Exactly. Focus on differentiation, like quality bathroom ink, maybe. Creating a truly unique, superior product. Better features, better quality, better brand image that customers are willing to pay a premium for because they perceive greater value.
Or maybe try to do both.
That's the best cost strategy.
Yeah.
Trying to combine elements of both offering higher perceived value, but at a reasonable, not necessarily the lowest price. It's about picking your strategic lane and sticking to it.
Makes sense. Now, what about going global? That seems essential today.
It really is for many businesses. In our interconnected world, international operations aren't just an option sometimes, they're a necessity. And what's fascinating here is the economic concept of comparative advantage.
Explain that again.
Sure, countries and companies, too, tend to specialize in producing what they do most efficiently relative to other things they could produce. Then they trade for what others do better.
Okay.
So, the example given was Bermuda. With its beautiful beaches, it specializes in tourism. It uses the income from tourism to efficiently import things it's not good at making, like vehicles or petroleum products. It maximizes its resources through specialization and trade.
But markets aren't always perfect, right? Trade isn't always easy.
Absolutely not. Think about High-Tech Components, Inc. They rely on specialized electronic parts from abroad. They face unique risks, maybe production shortages in another country, or skyrocketing shipping costs, or even political tensions disrupting supply chains.
Yeah, we see that all the time.
These imperfect markets, where trade might be limited by physical distance, transportation costs, or regulatory barriers, can really complicate global operations.
So how do companies actually go global? Is it just exporting?
Exporting and importing is the simplest way, sure. But there are many other approaches. They could engage in licensing, allowing a foreign company to use their technology or processes for a fee.
Like a brand name.
Could be a brand name or a patented process. Franchising is another popular option, like fast food chains. Or they could form joint ventures, sharing ownership and operations with a local partner in the foreign market.
Okay.
Many companies also engage in global sourcing. This is more integrated, synchronizing all levels of product manufacturing, from R&D to production to marketing, on an international basis to find the best cost and efficiency globally.
But doing business abroad must come with its own set of headaches.
All right.
Unique risks.
Oh, absolutely. A whole new layer of risk. Exchange rate fluctuations are a big one. You can get hit with transaction risk, affecting payments you need to make or receive in foreign currency. Economic risk, impacting the present value of your future foreign cash flows. Translation risk, when you convert foreign financial statements back into your home currency.
Wow. 3 types just for currency.
Yeah. And then you also have to contend with changes in foreign demand, shifts in foreign interest rates, local inflation rates eroding profits, and even significant political risks, things like new regulations, instability, or in the most extreme cases, expropriation, where a government might seize your assets.
Yikes. Definitely not for the faint of heart.
Not at all. Requires careful planning and risk management.
The financial engine, capital, valuation, and combinations.
Okay, let's shift gears now and dive into the financial engine. This is about the capital, the valuation, and the combinations that really fuel a business.
Right. The money side of things.
Let's start with capital structure. Think of it like a company's financial recipe, right? The specific mix of debt like loans and bonds and equity like preferred and common stock that it uses to finance its operations and drive growth, it's basically how they pay for everything they do.
That's a good way to put it. And what's crucial to understand here is that these different components of capital, debt, and equity, they come with different costs.
Costs, like interest payments.
Yes, but it's a bit more nuanced. For instance, the cost of debt, the interest rate you pay, is typically calculated after tax.
Why after tax?
Because interest expense a company pays on its debt is usually tax deductible. That provides a significant tax shield, effectively lowering the real cost of borrowing compared to the sticker price interest rate. It's a major benefit of using debt financing.
Okay, that's a key point. But then there's equity. That seems different.
It is. You have preferred stock, which often comes with fixed dividend payments, kind of like debt in that way, but without the tax shield. And then you have common stock, which represents true ownership and a claim on the company's future earnings.
How do you figure out the cost of common stock? There's no fixed interest rate.
Right. It's trickier. We use various methods to estimate the cost of retained earnings or the cost of new common stock. Popular models include the capital asset pricing model, or CAPM,
CPM, okay.
which basically adds specific risk premiums for market risk, company size, etc., to a baseline risk-free rate like a government bond yield. Or you might use the dividend discount model, which tries to value the equity based on the present value of its expected future dividends.
So it's more of an estimate based on expectations and risk.
Exactly. It's a blend of financial theory, market data, and, frankly, some judgment.
This all leads us to a core question for any business, right?
Yeah.
What's the optimal capital structure? Is there a perfect mix?
That's the million-dollar question. The theoretical optimal capital structure is that specific ratio of debt to equity that results in the lowest possible weighted average cost of capital, or WACC.
WACC. Okay, why is minimizing WACC so important?
Because a lower WACC, which represents the overall cost of financing the company, ultimately maximizes the firm's total value. It means the company can fund its investments more cheaply.
I see.
Now, while using more debt can create financial leverage, magnifying returns for shareholders when things go well, it also significantly increases financial risk.
The risk of not being able to make those debt payments.
Precisely. The risk of bankruptcy if the company hits a rough patch and can't meet its obligations. So finding that optimal structure is a really high-stakes balancing act between the benefits of debt, like the tax shield, and its risks.
Okay, so companies need fuel. How do they grow? Not always organically, right? Sometimes they combine.
Absolutely. Business combinations are a major way companies grow or reshape themselves. A horizontal combination is when companies operating at the same stage of production, often direct competitors, merge.
Like Heinz and Kraft Foods, the example given.
Exactly. The goal there. Often reduce competition, gaining greater market share, and achieving significant economies of scale, becoming bigger and more efficient.
Makes sense. What about vertical combinations?
Vertical combinations bring together companies at different stages of the same production process. Imagine Landbright Farms, an organic livestock breeder, merging with Fresh Meats, Inc., a meat transporter.
Okay, controlling more of the supply chain.
Right. It's about assuring the supply of necessary raw materials or securing distribution channels, controlling more of the overall value chain from start to finish.
Are mergers the only way?
No, there are other methods too. A tender offer is when a company makes a direct offer to the shareholders of another company to buy their stock at a specific price, often bypassing the target company's management.
Ah, sometimes hostile then.
Can be, yes. Or you might see an asset purchase, where a buyer acquires specific assets, maybe a factory, a product line, patents, but not necessarily the entire company structure. This can sometimes even lead to the selling company dissolving afterwards.
Okay, and sometimes companies need to get smaller, right? Focus.
Definitely. Divestitures involve selling off parts of the business. There are a few ways this happens. A sell-off is an outright sale of a subsidiary or division to another company.
Why would they do that?
Maybe the subsidiary's core operations no longer align with the parent company's overall strategy, or perhaps it's underperforming. The Betco Industries selling blended Ltd. example fits here.
Got it. What's a spin-off?
A spin-off is different. It creates a brand new independent company by distributing shares in that new entity to the parent company's existing shareholders.
So the shareholders now own two companies instead of one.
Essentially, yes. This often happens when a business unit is perhaps less profitable, operates in a completely different industry, or management believes it would be worth more standing on its own. The Eli Lilly spinning off its medical devices unit is a classic example. It's about unlocking value by separating distinct businesses.
Interesting. Okay, let's talk valuation. How do you actually put a price tag on an entire company or maybe just its stock?
One of the most common ways is using multiples. And the king of multiples is the price earnings, or PE ratio.
PE ratio. Heard that one a lot. How's it calculated again?
Simple calculation. You take the current market stock price and divide it by the company's earnings per share, EPS. It's the most widely used multiple for valuing equity because, well, earnings are generally considered a key driver of stock value over long run.
But it's not the only multiple, is it?
Oh no, definitely not. Other multiples offer different perspectives, which can be really useful. The PEG ratio, for instance.
PEG.
Yeah, PE divided by the company's expected earnings growth rate, so it factors in growth expectations. A lower PEG ratio, say below 1, is generally seen as more attractive by growth-oriented investors.
Okay. What else?
Then there's the price-to-book, PB ratio.
Mm-hmm.
That divides the stock price by the company's book value of common equity per share, basically, the company's net worth, according to its accounting records.
When would you use PB?
It's often more stable than earnings, which can fluctuate a lot, and it's incredibly useful when a company's earnings are negative or zero. In those cases, a PE ratio is meaningless, but PB still gives you a valuation anchor, however imperfect.
Makes sense. Can we value other things besides stock, like options or bonds?
Absolutely. We can value incredibly complex financial instruments. For options, there are sophisticated mathematical models. The Black-Scholes model is a famous one, typically used for European-style options.
Which can only be exercised at expiration.
Right. While the binomial model is often preferred for American-style options, which offer more flexibility as they can be exercised over a period of time. And for debt instruments like bonds, the basic idea is discounting. You calculate the present value of all their expected future cash flows, the periodic interest payments, and the final principal repayment using an appropriate market interest rate.
Okay, discounting future cash flows. That seems to be a theme.
It's a fundamental principle in finance. Which leads us to another tricky area. How do you value intangible assets? Things you can't physically touch, like patents or copyrights or brand names.
Yeah, that seems tough. How do you do it?
There are generally three approaches. First, a market approach. But that only works if there have been recent sales of reasonably comparable intangible assets, which is often rare.
Okay. What else?
Second, an income approach. This involves, you guessed it, discounting the future expected cash flows that the intangible asset is expected to generate over its useful life back to a present value. Eagle Road Enterprises valuing its patent based on expected future profits is an example of this.
And third.
A cost approach. This estimates either the cost to replace the intangible asset with a similar one, providing similar benefits, or the cost to reproduce an exact replica. This considers all the materials, labor, legal fees, and overhead needed. Alpine Inc. Using this for its unique copyrights makes sense here. It's about finding the most relevant way to assess value where you might not initially see it.
And speaking of value and estimates, accounting estimates themselves are hugely important in financial reporting, aren't they?
Absolutely crucial. And they involve a lot of judgment. Think about estimating the allowance for doubtful accounts, how much of your receivables you think you won't collect, or estimating the useful life of a big piece of equipment for depreciation purposes.
What do these rely on? Just guessing.
Oh no, it's more rigorous than that.
Yeah.
They rely heavily on historical data, current market information, the expected usage patterns of assets, and often input from internal or external experts. And because they involve judgment, they're always heavily scrutinized by auditors.
Right. Now, there's also this term fair value measurement. What does that mean exactly?
It's a very specific definition under accounting rules. Fair value isn't just any price. It's the hypothetical price you would receive to sell an asset, or the price you would pay to transfer a liability in an orderly transaction between knowledgeable, willing market participants on the date you're measuring it.
Okay, market participants. And it matters which market.
Yes. It considers the principal market.
Yeah.
That's the market with the greatest volume and level of activity for that specific asset or liability. Here's the key part. Even if another market exists where you might hypothetically get a slightly better price, you must use the price from the principal market for the fair value measurement.
Interesting rule. What about non-financial assets, like land or buildings?
For those, the concept of highest and best use is critical. You have to consider how market participants would use the asset to maximize its value. Would they use that piece of land for industrial purposes as it is now? Or would its highest and best use be, say, tearing down the factory and redeveloping it for residential housing, even considering the demolition and conversion costs? You value it based on that highest potential.
Fascinating. Lots of layers to valuation.
Indeed, there are.
Tools for smart decision-making.
Okay, let's dive into the core tools for smart decision-making that managers use every day. When a company is considering a new project, maybe building a new factory, launching a new product, how do they decide if it's truly worth the investment?
It really comes down to analyzing the cash flows. And I mean all the cash flows, not just the direct money coming in from sales or going out for costs.
But also indirect effects.
Exactly, like the tax savings you get from depreciating the new equipment you bought for the project. Depreciation itself isn't cash, but the tax shield it creates is real cash savings. Cash is absolutely king in these decisions.
So what's the main tool they use to analyze these cash flows?
One of the most powerful and widely accepted tools is the net present value, or NPV, method.
NPV, how does that work?
It discounts all the expected future cash inflows and outflows associated with the project back to their value today, using a specific discount rate. This rate is often the company's cost of capital or a rate adjusted for the project's specific risk.
And then what?
You sum up all those discounted cash flows. If the final NPV is positive, the project is generally considered acceptable because its expected return exceeds the minimum required hurdle rate. It's creating value.
Why is NPV often preferred over something like IRR, the internal rate of return?
Good question. While IRR tells you the project's percentage rate of return, NPV tells you the absolute dollar value added. NPV is generally considered superior, especially when comparing mutually exclusive projects with unconventional cash flow patterns like negative flows later on. NPV directly measures the expected increase in the firm's value, and it can handle changing discount rates over the project's life more easily.
Okay, NPV is king. What else is in the toolkit?
Well, sometimes you have more good projects than you have money to fund them. That's where the profitability index, or PI, comes in handy.
Profitability index, what's that?
It helps rank projects based on their efficiency in using capital. You calculate it by dividing the present value of the future cash inflows by the initial investment amount.
So a ratio of benefit to cost, basically.
Exactly. A PI greater than 1.0 means the project is expected to generate more value than it costs, consistent with a positive NPV. But importantly, a higher PI indicates a more desirable project in terms of bang for your buck.
Like the Beeman Enterprises example, they had a limited budget.
Precisely. With only $50,000 to spend, they couldn't fund all their positive NPV projects, so they'd use the PI to prioritize, strategically choosing the combination of projects like B, E, and A in the example. That gives them the highest total NPV within their budget constraint. It's about maximizing value with limited resources.
Very practical. Now, sometimes managers just want to know, how quickly do we get our money back?
Ah, yes. That leads to the payback period. It's a simple calculation. The time it takes for a project's cumulative cash inflows to exactly equal its initial cost.
Simple sounds good, but are there drawbacks?
Big drawbacks, actually. First, it completely ignores the time value of money. A dollar received in year 5 is treated the same as a dollar received in year 1. Second, it ignores all cash flows after the payback period. A project could pay back quickly but generate very little profit overall, or another might pay back slower but be vastly more profitable long term. Payback doesn't capture that.
So is there a better way to measure payback?
There is. The discounted payback method, sometimes called the break-even time or BET-T method. This one does use discounted cash flows in the calculation.
So it accounts for the time value of money.
Yes. It tells you how long it takes to recoup the initial investment in present value terms. While it still ignores cash flows after the payback period, it's a definite improvement, especially valuable for companies in, say, rapidly changing tech fields where recouping the investment quickly, even on a discounted basis, is really critical.
Okay. What about measuring overall economic profit, not just project returns?
For a truly holistic view of whether a company is generating real economic profit beyond just the accounting profit shown on the income statement, there's economic value added, or EVA.
EVA, how's that different from net income?
EVA calculates profit after deducting the cost of all the capital the company uses, both debt and equity capital. Net income only subtracts the cost of debt, interest expense. So a positive EVA means the company isn't just making money, according to accountants. It's actually creating true economic wealth for its shareholders after covering the opportunity cost of all the capital invested. It's a much tougher hurdle and a powerful measure of efficiency.
Interesting distinction.
Yeah.
What about day-to-day decisions like leasing versus buying equipment?
Companies run detailed lease versus buy analyses for those too. This decision is typically broken down into 2 parts.
2 parts.
Yeah. First, the investment decision. Does acquiring the asset, regardless of how it's financed, provide positive operational benefits? This is usually analyzed by discounting the operating cash flows the asset generates at the company's overall WACC. If that's positive, the asset itself is worthwhile.
Okay, step 1. Is the asset good for us?
Right. Step 2 is the financing decision. Assuming the asset is worthwhile, is it cheaper to buy it, often financed with debt, or to lease it? This comparison focuses only on the financing cash flows. Loan payments versus lease payments, tax shields from depreciation versus lease payments, and uses the company's after-tax cost of debt as the discount rate, because leasing is essentially a form of financing.
Like the Boulder Inc. example, comparing buying a machine versus an operating lease.
Exactly. The project should only be undertaken if the asset itself provides value, investment decision, and the present value of the cost of the best financing option, lease or buy, is less than the present value of the operating benefits it generates. It's a 2-stage process.
Got it. Now let's get down to the nitty-gritty, marginal analysis. Every business decision seems to boil down to comparing costs and benefits. But which costs really matter?
That's the key question. Only relevant costs matter for decision-making, and relevant costs have two characteristics. They must differ between the alternatives you're considering, and they must be future costs, not costs already incurred.
Okay, future costs that differ. What about opportunity costs?
Opportunity costs, the benefit of the next best alternative you give up when you make a choice, are always relevant costs. They represent a real economic sacrifice, even if no cash changes hands directly.
So what costs are irrelevant?
This is often counterintuitive, but sunk costs are completely irrelevant.
Sunk costs.
Yeah, those are costs that have already been incurred in the past and cannot be recovered no matter what you decide now. Think about the money Electromag Corporation already spent on its old equipment. That cost is sunk and totally irrelevant to the decision of whether to replace the equipment now. It's gone. Don't let it cloud your future judgment.
Okay, ignore sunk costs. What else?
Also irrelevant are unavoidable costs. Costs that will continue regardless of which alternative you choose. If a cost doesn't change between your options, it can't be relevant to choosing between them. You really have to focus only on the costs and benefits that will change based on your decision.
This helps clarify things like accepting special orders, right?
Absolutely. Take the cater company example. If they have excess production capacity machines and workers sitting idle, they'd likely accept a special one-time order as long as the selling price per unit covers at least their variable costs, materials, direct labor, variable overhead, plus any incremental fixed costs for that specific order. Any price above that contributes to covering existing fixed costs and profit.
But what if they're already operating at full capacity?
Wow, then it's different. If they're at full capacity, accepting the special order means they have to give up some of their regular sales. So the minimum acceptable price for the special order must cover not only the variable costs, but also the opportunity cost, which is the contribution margin they lose from the regular sales they displace. That makes the required price much higher.
Okay, opportunity cost is key when capacity is tight. How about the make versus buy decision, insourcing versus outsourcing?
Very similar logic. If offset manufacturing has excess capacity, the relevant cost of making something internally is essentially the cost that will be avoided if they don't make it and instead buy it from an outside supplier.
So mainly the variable costs.
Primarily variable costs, plus any avoidable fixed costs associated with that production. If the cost to buy from outside is less than these avoidable internal costs, then buying makes sense, assuming quality and reliability are equal. Managers should always choose the lowest cost alternative, carefully considering only the relevant costs that truly change between making or buying.
And what about products that reach a certain stage and you have to decide whether to sell them as they are or process them further, like Jackson Inc. with its raw materials?
That's the sell or process further decision. The rule here is quite clear. You compare the incremental revenue you'd gain from processing the product further against the incremental costs you'd incur after the split-off point.
Split-off point.
That's the point in the production process where joint products become separately identifiable. Any costs incurred before the split-off point, joint costs, are irrelevant to this decision because they're sunk costs at this stage. You only look at the extra revenue versus the extra cost from this point forward. If the incremental revenue is higher than the incremental processing cost, you process further. Simple as that.
Makes sense. And this logic also applies to keeping or dropping a whole product line or segment.
Yes, the keep or drop a segment decision follows similar principles, but you need to be careful with fixed costs. If Chowderhead's conch chowder product line has unavoidable fixed costs, maybe allocated corporate overhead or a factory lease they can't get out of, those costs will continue even if the line is eliminated.
So those are irrelevant to the decision.
Exactly. The focus shifts to whether the segment's contribution margin, its revenue minus its variable costs, is positive, and how it compares to the segment's avoidable fixed costs, those fixed costs that would disappear if the segment was dropped.
So what's the rule?
If the avoidable fixed costs you'd save by dropping the segment are more than the contribution margin you'd lose, then dropping the segment would actually increase the company's overall profit. It's a nuanced calculation focusing on avoidability.
Wow, okay. Marginal analysis is powerful, but requires careful identification of what's truly relevant.
Absolutely critical.
So how do businesses meticulously track all this spending and assign it to different parts of their operations? Let's talk cost accounting.
Right. It starts with identifying cost objects. That's just the technical term for anything you want to measure. The cost of it could be a specific product, a service line, a project, a customer, or even an entire department.
Okay, cost objects.
Right.
And there's a fundamental distinction in how costs are treated, right? Product versus period costs.
Yes, this is foundational. Product costs are all the costs directly associated with manufacturing goods. This includes direct materials, the raw stuff, direct labor, the workers touching the product, and manufacturing overhead, all other factory costs like indirect materials, indirect labor, factory rent, depreciation on factory equipment.
And how are these treated?
These product costs are considered assets. They're capitalized as part of inventory value on the balance sheet until the product is actually sold. Only then do they move to the income statement as cost of goods sold, matching the expense with the revenue.
Okay, so they stick with the inventory. What are period costs?
Period costs are basically all the non-manufacturing costs. Think selling expenses, advertising, sales commissions, and administrative expenses. Office salaries, office rent, corporate headquarters costs.
And they aren't attached to inventory.
Correct. These are expensed immediately in the period they are incurred, regardless of when products are sold. They hit the income statement right away. It's all about the timing of expense recognition.
The Spud Furnishings, Inc. example helped me here. They talked about direct costs versus indirect costs.
Yeah, that's another key distinction within product costs, and sometimes period costs too. Direct costs are costs that can be easily and conveniently traced to a specific cost object. Like the fabric used for one specific custom couch order at Spud Furnishings, you know exactly how much fabric went into that couch.
Okay, easily traceable. What are indirect costs then?
Indirect costs are costs that are related to the cost object but cannot be easily or economically traced directly to it. Think about the cleaning supplies used in the entire furniture factory, or the factory supervisor's salary, or the electricity bill for the factory. These benefit multiple products.
So how do they get assigned to products?
These indirect manufacturing costs are initially lumped together into a pool called manufacturing overhead. Then, this overhead pool is carefully allocated to the individual products or jobs using some logical allocation base, like machine hours or direct labor hours. It's an estimation process.
Got it. Now, you also mentioned how costs behave when production volume changes. Variable, fixed.
Right. Cost behavior is critical for planning and control. Variable costs change in total proportionally with the level of activity. If you double production, your total direct materials cost doubles. But importantly, the variable cost per unit remains constant within a relevant range.
Okay, total varies. Per unit is constant. What about fixed costs?
Fixed costs are the opposite. They remain constant in total, regardless of the production volume, at least within a certain relevant range of activity. Think about the factory rent. It's the same whether you make 100 units or 1,000 units up to a point. But the fixed cost per unit will vary inversely with activity. If your fixed rent is $1,000 and you produce 100 units, the fixed cost is $10 per unit. If you produce 200 units, it drops to $5 per unit.
Spreading the fixed cost over more units.
Exactly. And then you have mixed costs, which, as the name implies, have both a fixed component, like a base monthly fee, and a variable component, like a per unit charge. Utilities are often a good example.
Okay, different cost behaviors. And companies track these costs differently depending on the product. You mentioned job order versus process costing.
Yes, the costing system needs to match the production environment. Job order costing is used when a company produces unique, customized products or services, often in batches or individual units. Think custom home building, aircraft assembly, printing jobs, professional services. Each job gets its own unique cost record, where direct materials, direct labor, and allocated overhead are tracked specifically for that job.
So unique jobs, unique costs. What's process costing?
Process costing is used when a company mass produces large quantities of identical or very similar homogeneous products in a continuous flow. Think chemicals, oil refining, flour, or the fruit pies made by Fresh Baked Company in the example.
How does that work? No individual job records.
Right. Instead of tracking costs by job, costs are accumulated by department or process for a given period. Then, these total costs are averaged over the large number of equivalent units produced during that period to get an average cost per unit. It's all about averages for mass production.
Makes sense. Now, what about when things go wrong? Spoilage.
Ah, yes, spoilage. It happens. We distinguish between normal spoilage and abnormal spoilage.
Normal spoilage. Sounds like an oxymoron.
It does, but it refers to the expected, unavoidable amount of defective units that naturally occur even under efficient operating conditions. It's just part of the process.
So how is that treated?
Interestingly, the cost of normal spoilage is actually capitalized as part of the cost of the good units produced. It gets absorbed into the inventory cost, effectively increasing the per unit cost of the good units that passed inspection.
Okay, so the good units bear the cost of the expected failures. What about abnormal spoilage?
Abnormal spoilage is spoilage that is not expected to occur under normal, efficient operations. Maybe a machine malfunctioned badly, or there was a specific error. Because this shouldn't have happened, its cost is not added to inventory. Instead, it's immediately expensed as a period cost, usually shown as a separate loss on the income statement. It's treated as an avoidable loss.
Like the fresh baked company example. A few bad pies are normal spoilage, but a whole batch ruined by an accident is abnormal.
Perfect illustration.
Now, you mentioned allocating that tricky manufacturing overhead. Is there a more precise way than just using one simple rate?
Yes, absolutely. For companies wanting much more accuracy, especially if they have diverse products with different demands on resources, activity-based costing, or ABC, comes into play.
ABC. How is different?
Instead of using a single, broad, often volume-based overhead rate, like direct labor hours for the whole factory, ABC identifies various specific activities that drive overhead costs, like machine setups, purchase order processing, quality inspections, engineering design. It then allocates overhead costs to products based on how much of each activity those products actually consume.
So it traces costs based on activities, not just volume.
Exactly. If designing a complex new product requires a lot of engineering activity, the costs of that engineering activity pool are assigned more heavily to that product. It provides a much more detailed, focused, and often dramatically different view of true product costs compared to traditional methods. It's a real game changer for understanding profitability.
Wow. Okay. What about when multiple products come from the same process? Like different cuts of meat from one steer?
Ah, yes, that's joint product costing.
Okay.
You have a single production process that yields multiple products simultaneously up to a certain point.
The split-off point.
Right. The challenge is how to allocate the common costs, all the costs incurred before that split-off point to the different joint products. There are various methods, often based on factors like their relative physical volume, for example, pounds or gallons, or more commonly, their relative sales value at the split-off point.
So you allocate based on their value.
Often, yes. The idea is that products with higher sales value should bear a larger share of the joint costs. And then you also have byproducts.
That's products.
These are products that emerge from the same joint process but have a relatively low sales value compared to the main joint products. Think sawdust from a lumber mill. Their revenue might be treated simply as a reduction of the overall joint costs, rather than allocating joint costs to them.
Okay, lots of ways to slice and dice costs.
Beyond tracking internal costs, how do companies know if they're actually doing well compared to others, or even their own past performance?
Good question. Benchmarking.
Exactly. Benchmarking is a key tool. It involves comparing your company's processes, products, services, and performance metrics against those of industry leaders, direct competitors, or even best-in-class internal departments. It's all about identifying gaps and finding opportunities for improvement by learning from the best.
How else can they measure performance? Productivity seems important.
Very important. We can measure productivity in various ways. For example, Garden Furnishings, Inc. could calculate its partial productivity, like how many sculptures they produce per pound of plastic used. That focuses on one input.
Okay.
Or they could calculate total factor productivity, TFP, which compares the value of total outputs to the total cost of all inputs used, labor, materials, capital. A higher productivity ratio, whether partial or total, always indicates greater efficiency in using resources.
And what about measuring quality, preventing defects?
Quality control has some great visual tools. Control charts are used to monitor defects or process variations over time. Think about tracking the number of defects found per batch in tire production. The chart shows if the process is staying within statistically determined upper and lower control limits, highlighting any spikes or trends that signal a problem.
So you can see when things are going off track.
Precisely. And Pareto diagrams are fantastic for prioritizing quality problems. It's basically a bar chart that ranks causes of problems, like types of defects or sources of customer complaints, from the most frequent or most costly down to the least. It helps you focus your efforts on the vital few issues that are causing the most pain, following the 80-20 rule.
Tackle the biggest problems first. Makes sense.
Once a major problem is identified using a Pareto chart, a cause and effect or fishbone diagram can help brainstorm and visualize all the potential root causes. It typically categorizes potential causes under headings like machinery, method, materials, manpower, measurement, and environment. It's a structured way to get to the bottom of why things are going wrong.
Cool tools. But performance isn't just about financials or defects, is it?
Absolutely not. Non-financial measures are critically important for getting a complete picture of performance, and often they are leading indicators of future financial success.
Like what?
Think about customer retention rate. Gertie's 90% retention rate in the example tells you immediately about strong customer loyalty, which usually translates to future revenue. Or employee turnover rate, like Duffy's 16% high turnover, signals potential problems with morale, productivity loss, and significant costs for recruiting and training replacements.
Even things like customer service response times.
Definitely. Ticket response time for customer service, where a lower time is obviously better, provides crucial operational insights into efficiency and customer satisfaction that aren't directly captured on the main financial statements.
Right. And speaking of numbers, I've heard of non-GAAP measures. What are those?
Yes. Non-GAAP measures are financial metrics that companies sometimes report which aren't defined by generally accepted accounting principles. They adjust the standard GAAP figures to, theoretically, give investors and management a clearer picture of underlying operating performance.
Why adjust GAAP? Isn't that the standard?
It is, but GAAP includes certain items that might not reflect ongoing operations or can vary significantly between companies due to accounting choices. A very common non-GAAP measure is EBITDA, earnings before interest, taxes, depreciation, and amortization.
EBITDA. Heard that one too.
By stripping out interest, taxes, and non-cash expenses like depreciation and amortization, EBITDA aims to provide a more comparable view of core operational profitability, less affected by financing decisions or accounting policies. But you have to be careful they can also be used selectively by management, so understanding what adjustments were made is key.
Okay. So how do managers track performance across different parts of a large business,
Right.
like divisions or regions?
They use responsibility segments, often called strategic business units, or SBUs. These segments are defined based on what level of performance the manager of that unit is actually held accountable for.
Accountable for what?
It varies. A manager might run a cost center, accountable only for controlling costs, like a maintenance department, or a revenue center, focused solely on generating revenue, like a sales office. A profit center manager is responsible for both revenues and costs. And an investment center manager has the broadest responsibility controlling revenues, costs, and the assets invested in their unit, often measured by return on investment, ROI, or residual income. It defines their scope of control and how they're evaluated.
And you can see this breakdown in certain reports, right? Like contribution reporting.
Exactly. Contribution reporting provides a really insightful income statement format that highlights cost behavior and managerial responsibility. It starts with sales revenue, subtracts variable costs to get the contribution margin. That's how much is available to cover fixed costs and contribute to profit. Then it subtracts the controllable fixed costs, those fixed costs that the segment manager can directly influence to arrive at the controllable margin. The Delta Manufacturing Performance Evaluation for its regions clearly illustrates this, showing profitability at different levels of cost control and accountability for each regional manager.
That seems much more useful for evaluation than just a standard income statement.
It really is. But even that can be improved upon. The balanced scorecard takes this multidimensional view even further.
Balanced scorecard. How does that work?
It provides a truly holistic framework for evaluating performance. It looks at results not just from the traditional financial perspective, but also through three other critical lenses: customer satisfaction, how do customers see us? Internal business processes, what must we excel at internally? Learning and growth, can we continue to improve and create value?
So it balances financial goals with non-financial ones.
Precisely. It ensures that strategic goals are being pursued and achieved across multiple critical dimensions, preventing managers from focusing only on short-term financial results at the expense of long-term drivers of success, like customer loyalty or innovation.
Okay, performance measurement is key. But how do companies plan for the future in such an uncertain world? How do they project and budget?
They use various projection techniques to create what-if scenarios and anticipate potential outcomes. Sensitivity analysis is a common one.
Sensitivity analysis.
Yeah, it changes just one key variable at a time, like sales volume or material cost or interest rates, to see how sensitive the projected outcome, like profit or NPV, is to changes in that single variable. It helps identify the most critical assumptions.
Okay, changing one thing at a time. What if multiple things might change?
That's where scenario analysis comes in. It's more complex, but often more realistic. Instead of changing just one variable, scenario analysis builds multiple internally consistent alternative future scenarios, maybe an optimistic case, a pessimistic case, and a most likely case. You assign probabilities to each scenario and then analyze the potential outcomes under each. Ridge Company forecasting sales under different economic futures is a good example. It gives a range of possibilities.
It's like stress testing your plans against different futures.
Exactly. Another powerful tool, more statistical in nature, is regression analysis.
Regression sounds mathematical.
It is, but it's incredibly useful. Regression analysis helps find statistical relationships between two or more variables. For example, you could use it to predict how changes in production volume, the independent variable, might affect total manufacturing costs, the dependent variable, based on historical data.
So it finds patterns in the data.
Yes, and it quantifies them. The coefficient of correlation, R, tells you the strength and direction, positive or negative, of the linear relationship between the variables. And R squared, the coefficient of determination, tells you how well your regression model actually fixed the data. What percentage of the variation in the dependent variable costs can be explained by changes in the independent variable production volume. It's about building predictive models from data.
Wow. Okay, for more practical day-to-day budgeting, you mentioned the high-low method.
Yes, the high-low method. It's a simple technique used to separate the fixed and variable components out of a mixed cost. You just take the highest activity level and the lowest activity level from your historical data, find the difference in costs and the difference in activity between those 2 points, and that gives you the variable cost per unit. Then you can back into the fixed cost component.
Simple but useful for getting a cost formula.
Exactly. It helps you develop a cost formula, like total cost, fixed cost, plus variable cost per unit activity level. This formula is then essential for creating a flexible budget.
Flexible budget. How's that different from a regular budget?
A standard or static budget is prepared for only one expected level of activity. A flexible budget, using the cost formulas derived from methods like high-low or regression, can be adjusted to show what costs should have been for the actual level of activity achieved during the period.
So you can compare actual results to a budget that reflects the actual volume.
Precisely. It allows for much more meaningful performance comparisons, apples to apples, than comparing actual results to a static budget based on a different activity level. It isolates the impact of volume changes from cost control efficiency.
Very smart. Now, you mentioned something really intriguing earlier, the learning curve. What's that about?
The learning curve phenomenon is fascinating. It's based on the observation that as workers gain experience with a repetitive task, they become more efficient. Specifically, the theory states that as cumulative production doubles, the average time required to produce each unit decreases by a constant percentage.
So people get faster as they make more.
Consistently faster in a predictable pattern. The Jones Production Company example showed this. If they have, say, a 70% learning curve, the average time to produce the second unit will be 70% the time it took to produce the first. The average time for the first 4 units will be 70% of the average time for the first 2, and so on. This cumulative average time keeps shrinking.
That has big implications for cost estimation and production planning.
Huge implications, especially for industries with complex assembly or highly skilled labor where learning effects are significant.
Okay, at a really fundamental level, businesses need to know their break-even point, right?
Absolutely. Cost, volume, profit, CVP analysis, and its core component break-even analysis are fundamental tools. They help managers understand the relationship between costs, sales volume, and profit.
So breaking is the point where you're not making money, but not losing it either.
Exactly. It's the sales level, in units or dollars, at which total revenues equal total costs, both fixed and variable, resulting in zero profit. The green grass example walked through calculating this. They needed to sell 2,000 units just to cover all their costs.
And CVP analysis can also tell you how many units you need to sell to achieve a desired profit target.
Yes, that's a common extension. You just add your target profit to your fixed costs in the numerator of the break-even formula. Greengrass needed to sell 2,800 units to hit their $60,000 pre-tax profit goal. It's essential for setting sales goals and making pricing decisions.
Speaking of pricing, sometimes companies work backward from the price, don't they? Target costing.
Yes, target costing flips the usual script. Instead of cost plus desired profit equals selling price, it starts with the competitive market price the company believes it can achieve. Then it subtracts the required profit margin the company needs. The result is the maximum allowable target cost for the product.
Market price, required profit, target cost.
Right. This forces the company to focus intensely on designing the product and streamlining its production processes to meet that predetermined target cost. It's brilliant for driving efficiency and ensuring profitability in competitive markets.
But is there a risk?
There can be. The relentless pressure to reduce costs to meet the target could sometimes lead to compromises in quality or features if not managed very, very carefully. It requires a strong focus on value engineering.
Okay. Let's talk budgets themselves. They're more than just spreadsheets of numbers, aren't they?
Oh, much more. Budgets are powerful management tools. They serve as detailed plans that communicate goals across the organization, they can motivate teams to achieve those goals, and they provide a benchmark for evaluating actual performance later on.
Where does the budgeting process usually start?
It almost always starts with the sales budget. This is the forecast of expected sales revenue, units and dollars. It's the cornerstone because nearly everything else depends on how much you plan to sell.
So sales drives production.
Exactly. The sales budget directly drives the production budget. This calculates precisely how many units need to be produced based on the sales forecast and the company's desired levels of beginning and ending finished goods inventory.
Production, sales plus desired ending inventory, beginning inventory, something like that.
That's the basic formula. From the production budget flow, the budgets for direct materials, direct labor, and manufacturing overhead needed to support that production level.
What about non-manufacturing costs?
Then you have the selling and administrative expense budgets, which cover all those period costs we talked about earlier.
And maybe the most critical one for survival.
Arguably, yes.
Yeah.
The cash budget. This is a detailed forecast of all expected cash inflows from sales, collections, financing, and cash outflows for materials, labor, overhead, operating expenses, loan payments, capital expenditures.
Why is the cash budget so vital?
Because it helps manage liquidity. It predicts potential cash shortages or surpluses, allowing management to arrange financing before a crisis hits or plan productive uses for excess cash. Avoiding running out of cash is paramount.
Okay, so budgeting plans for the future. Once a period ends, how do we analyze what actually happened? Financial statement analysis.
Right. After the accounting cycle closes and the financial statements are prepared, financial statement analysis using ratios helps us understand the company's performance and financial condition.
What kinds of ratios? Profitability seems key.
Definitely. Profitability ratios measure how successful the company was in generating profits. Examples include gross profit margin, gross profit sales, shows profit left after covering cost of goods sold, net profit margin, net income sales, shows overall profitability per dollar of sales, return on equity, ROE, net income average shareholders' equity, measures return generated for the owners, return on equity, ROE, net income average shareholders' equity. Higher profitability ratios are generally better.
What about paying the bills? Short-term health.
For that, we look at liquidity ratios. These measure a company's ability to meet its short-term obligations as they come due. Common ones are current ratio, current assets, current liabilities, a broad measure of short-term solvency. Quick ratio, or acid test ratio, current assets, inventory, current liabilities. A more conservative measure, excluding inventory, which might not be quickly convertible to cash. Quick ratio, or acid test ratio, current assets, inventory, current liabilities. Higher liquidity ratios generally suggest greater ability to pay short-term debts, providing a safety cushion.
Okay. And how efficiently is the company using its assets?
That's where activity ratios, sometimes called efficiency or turnover ratios, come in. They show how well a company is managing and utilizing its assets. Key examples include accounts receivable turnover, sales average accounts receivable, shows how quickly customers are paying their bills. Higher is better. Inventory turnover, cost of goods sold average inventory, shows how quickly inventory is being sold. Higher generally means more efficient inventory management.
There's also the cash conversion cycle.
Yes. The cash conversion cycle measures the average time it takes for a company to convert its investments in inventory and other resources back into cash. It combines inventory turnover, accounts receivable turnover, and accounts payable turnover. A shorter cash conversion cycle is generally better, as it means the company needs less financing for its working capital. Cash is tied up for less time.
Lots of ratios. How do you compare them across companies or over time?
It can be tricky if the companies are different sizes. That's where common size financial statements are incredibly useful.
Common size? What's that?
It's a simple but powerful technique. You restate every line item on a financial statement as a percentage of a relevant total. For the income statement, each item, cost of goods sold, operating expenses, net income, is shown as a percentage of total sales revenue. For the balance sheet, each asset, liability, and equity item is shown as a percentage of total assets.
It removes the effect of absolute size.
Exactly. This allows for incredibly easy comparison of a company's financial structure and performance trends over time, or against competitors, even if their absolute dollar figures are vastly different. It highlights the underlying proportions and strategic choices, not just the raw numbers, really illuminates trends.
Brilliant. Okay, so we have all these numbers, ratios, metrics.
Mhm.
How do they turn into real, actionable insights? Let's talk data analytics.
Right. Data analytics is the process of examining raw data to draw conclusions and support decision-making. It all starts with the data itself. Often, this is structured data.
Structured data, like in spreadsheets.
Pretty much. Think data organized neatly in tables with defined columns, which we call attributes, like customer name, purchase amount, date, and rows, which are individual records, like one specific customer transaction. In databases, these tables are often linked together using keys, like a unique customer ID number that appears in multiple tables.
And there's something called normalization.
Yes, normalization is a process used in database design to reduce data redundancy and improve data integrity. It involves breaking down large tables into smaller, less redundant, linked tables, ensuring that data is stored logically and efficiently. Keeps things tidy and consistent.
But before you can analyze data, it needs some work, right? Transformation.
Absolutely. Raw data is often messy. Data transformation, or data cleansing, is a critical step. This involves ensuring completeness, checking for missing values, cleaning it, removing unnecessary headers or footnotes, fixing inconsistencies like having CA, Calif, and California all used for the same state, validating accuracy, and often encrypting sensitive information like credit card numbers or personal IDs to ensure security and privacy.
Got to have clean, reliable data to start with.
Garbage in, garbage out, as they say.
And then comes visualization, making sense of it visually.
Yes. Data visualization is about presenting data graphically to make complex information understandable and actionable. It's an art and a science, choosing the right chart type, bar chart, line graph, scatter, plot, map, using appropriate scaling on the axes, and employing color strategically are all crucial for making trends clear, and, importantly, avoiding misinterpretation. A bad visual can be worse than no visual at all.
Okay, so once the data is clean and visualized, what kind of insights can analytics actually provide? I hear there are different types.
There are generally 4 types, often viewed as a progression in complexity and value. First, descriptive analytics. This tells us what happened. It summarizes past activities and trends using dashboards, reports, and basic statistics. Think sales reports showing revenue by region last quarter.
Okay, looking backward, what's next?
Second, diagnostic analytics. This digs deeper into why did it happen. It tries to uncover correlations, patterns, and root causes behind the trends identified by descriptive analytics, like linking a spike in late customer payments to customers having high debt levels and low cash flow scores in their profile.
Finding the why, then.
Third, predictive analytics. This forecasts what will happen. It uses statistical models like regression, time series analysis, or machine learning classification algorithms to project future outcomes based on historical patterns. Predicting customer churn, forecasting sales, or projecting machine maintenance needs fall here.
Trying to see the future. And the last one.
Fourth, and often the most valuable, is prescriptive analytics. This tells us what should happen or what should we do about it. It goes beyond prediction to offer concrete recommendations, optimal paths, or decision options. Think about a what-if scenario model suggesting the best tax strategy given certain assumptions, or an optimization model finding the most efficient delivery routes.
So descriptive, diagnostic, predictive, prescriptive, a whole spectrum.
Exactly. And data analytics is being used everywhere in modern business now, from building incredibly precise customer profiles for targeted marketing to streamlining operations by identifying bottlenecks, managing risk and compliance through continuous financial monitoring, vastly improving the efficiency and effectiveness of audits by analyzing entire data sets instead of just samples, and even optimizing complex tax planning strategies.
It really sounds like a foundational tool now, not just a niche specialty.
Absolutely. It's becoming essential for making smart, data-driven decisions across the entire business landscape.
Advanced financial concepts.
Okay, let's move into some potentially more complex areas. Advanced financial concepts. First up, how companies actually recognize revenue. It sounds simple, but I gather the art of earning has specific rules.
Oh, yes. Revenue recognition, especially under the relatively recent standard ASC 606, is quite detailed. There's a core 5-step model that companies must follow.
5 steps. Okay, what are they?
Step 1. Identify the contract with the customer. Step 2. Identify the separate performance obligations, the distinct promises to deliver goods or services within that contract. Step 3. Determine the total transaction price for the contract. Step 4. Allocate that transaction price to each of the separate performance obligations based on their relative standalone selling prices. And finally, Step 5. Recognize revenue when, or as the entity, satisfies each performance obligation by transferring control of the promised good or service to the customer.
Wow. Okay, that sounds systematic.
It is, and it gets particularly complex in certain situations, like long-term construction contracts spanning multiple years.
How does that work? Do they wait until the very end?
Not necessarily. Revenue might be recognized over time throughout the construction period if certain criteria are met. Key criteria include things like the asset being built having no alternative use to the builder, and the builder having an enforceable right to payment for performance completed to date. Canterco, building a very specific, custom unit for a customer, might qualify for overtime recognition.
And if those criteria aren't met?
Then revenue might have to be recognized only at a point in time, typically when the construction is complete and control is transferred to the customer. For instance, if a customer's deposit is fully refundable until the entire project is finished, that points towards point-in-time recognition. The timing difference can have a huge impact on reported profits year to year.
What other tricky scenarios pop up?
Well, there are bill and hold arrangements. That's where a company bills a customer for goods, but physically retains the goods for later delivery. Specific criteria must be met to recognize revenue before delivery, mainly proving the customer truly controls the goods, even while they're still in the seller's warehouse. It's restrictive.
Okay. What about consignment?
In a consignment arrangement, a company, the consignor, ships goods to a dealer, the consignee. But the consignor still retains ownership. The dealer only pays the consignor if and when they sell the goods to an end customer. So the consignor can only recognize revenue when that final sale occurs, not when they ship the goods to the dealer.
Makes sense. Even warranties have rules.
Yes. How warranties are accounted for depends on whether they provide a service, in addition to simply assuring the product works as intended, and whether they can be purchased separately. A standard assurance type warranty is just accrued as a cost. But an extended warranty, or one sold separately, might be treated as a separate performance obligation, with its revenue recognized over the warranty period.
Lots of details. What about repurchase agreements? Selling something and agreeing to buy it back.
Right. Repurchase agreements require careful analysis. If a company sells an asset but has the right, a call option, or the obligation, a forward or put option to buy it back, you have to determine if control really transferred. Is it truly a sale?
Or is it something else?
Exactly. Depending on the repurchase price relative to the original selling price and expected market value, the transaction might actually be accounted for as a lease, if the seller retains the right to use the asset, or simply as a financing arrangement, if it's essentially a loan collateralized by the asset. The Anderson cut excavator examples in the source material with different call and put option scenarios perfectly illustrate these nuances. It boils down to the economic substance, who really has control, and the risks and rewards of ownership.
Okay, substance over form. Now let's connect some corporate dots. Business combinations and consolidations. When does one company have to include another company's results in its own financial statements?
The general rule is based on control. When one company gains control over another, typically defined as owning more than 50% of its outstanding voting stock, they generally have to consolidate their financial statements.
Consolidate, meaning merge them together.
Yes, for reporting purposes. It means combining the assets, liabilities, revenues, and expenses of the parent company and its controlled subsidiary line by line, as if they were one single economic entity, even though they might remain separate legal entities. It's about presenting a unified financial picture to investors.
Is it always about owning over 50% of the stock?
Not always. There's an important exception, or rather different model, called the variable interest entity, VIE model.
VIE, what's that for?
This model applies to situations where control might not be evident through majority voting interest. A VIE is typically an entity that might lack sufficient equity investment at risk to finance its activities on its own, or where the equity holders lack the usual characteristics of control, like decision-making rights or absorbing loss-receiving benefits.
So like special purpose entities.
Often, yes. Think special purpose entities. certain leasing arrangements, or joint ventures structured in specific ways. If a company is determined to be the primary beneficiary of a VIE, meaning it has the power to direct the VIE's significant activities and the obligation to absorb its losses or the right to receive its benefits, then that company must consolidate the VIE, even if it doesn't own more than 50% or any of the voting stock. It's about effective financial control, not just voting rights.
Okay, that's a key distinction. Now, when a company does acquire another using the voting interest model, how does the accounting work? You mentioned the acquisition method.
Right. Under the acquisition method, the acquiring company records 100% of the identifiable assets acquired and liabilities assumed of the acquired company, the subsidiary, at their estimated fair values on the acquisition date. This happens regardless of the percentage of ownership acquired, even if it's less than 100%. It's like a fresh start valuation for the subsidiary's balance sheet within the consolidated entity.
100% at fair value. What if the price paid is more than the fair value of those net assets acquired?
That difference. The excess of the total consideration transferred, purchase price plus fair value of any non-controlling interest, over the fair value of the identifiable net assets acquired, is recorded as goodwill.
Goodwill, that intangible asset.
Exactly. Goodwill represents the future economic benefits arising from assets acquired that are not individually identified and separately recognized, things like synergies, reputation, workforce, etc. It's not amortized, expensed gradually over time anymore under U.S. GAAP or IFRS.
Oh.
Instead, it's tested for impairment at least annually. If its value is deemed to have declined, an impairment loss is recorded.
What if the price paid is less than the fair value of the net assets, a bargain purchase?
That can happen. If the fair value of the identifiable net assets acquired actually exceeds the total consideration transferred, the acquirer recognizes a gain on the acquisition directly in earnings on the acquisition date. It's like getting assets for less than they're worth.
Interesting. What about future payments tied to performance? Contingent consideration.
Good point. Sometimes the acquirer agrees to pay more to the former owners of this subsidiary. If certain future conditions are met, like the subsidiary achieving a specific earnings target within a few years. This potential future payment, the contingent consideration, must also be estimated at its fair value on the acquisition date and included as part of the total consideration transferred when calculating goodwill or a gain. It's all about capturing the full economic picture of the deal from day one.
Okay, acquisition accounting is complex. Let's switch gears to hedged bets. Derivatives and hedge counting. What exactly are derivatives?
Derivatives are financial instruments whose value is derived from some other underlying asset, index, or rate. The underlying could be a stock price, a commodity price like oil, an interest rate, a currency exchange rate, anything that fluctuates.
So their value depends on something else changing. Examples.
Common examples include futures contracts, standardized agreements traded on an exchange to buy or sell a specific asset at a predetermined price on a future date. Forward contracts, similar to futures but they're customized, private agreements between two parties not traded on an exchange. Options, contracts that give the buyer the right, but not the obligation, to buy a call option or sell a put option, an underlying asset at a specified price, the strike price, on or before a certain date. Swaps, agreements to exchange cash flows based on an underlying rate or index, like interest rate swaps or currency swaps.
Okay. And hedging is using these to manage risk.
Exactly. Hedging uses derivatives to offset potential anticipated losses or reduce earnings volatility arising from specific business risks. For example, a company might use a foreign currency forward contract to lock in the exchange rate for a large purchase it needs to make in euros in 3 months, protecting itself if the euro strengthens against its home currency.
But there's special accounting for this. Hedge accounting.
Yes. Normally, derivatives are marked to market with gains and losses flowing through earnings each period, which can cause volatility. Hedge accounting provides special treatment that allows the gains or losses on the hedging derivative to be recognized in the same period as the gains or losses on the item being hedged, providing a better matching and reducing earnings volatility.
But you have to qualify for it.
Absolutely. To qualify for hedge accounting, stringent requirements must be met. This includes formal documentation at the inception of the hedge, clearly outlining the risk management objective, the hedging strategy, the specific derivative instrument, the specific item or transaction being hedged, the nature of the risk being hedged, e.g., fair value risk, cash flow risk, and how the hedge effectiveness will be assessed on an ongoing basis. It's all about proving the hedge is legitimate and effective.
Okay. Are there different types of hedges for accounting?
Yes, generally 3 main types. First, a fair value hedge. This hedges the exposure to changes in the fair value of an existing recognized asset or liability, or an unrecognized firm commitment. Think hedging the value of fixed-rate debt against changes in interest rates using an interest rate swap.
How are gains losses treated?
For a qualifying fair value hedge, the gains or losses on both the hedging derivative and the change in fair value of the hedged item attributable to the hedged risk are recognized immediately in earnings. They are designed to largely offset each other in the income statement.
Okay, offsetting in earnings. What's a cash flow hedge?
A cash flow hedge protects against variability in future cash flows related to a recognized asset or liability, like variable rate debt, or a forecasted transaction, like a future purchase or sale in foreign currency.
And the counting is different.
Yes. For a qualifying cash flow hedge, the effective portion of the gain or loss on the hedging derivative is initially reported in Other Comprehensive Income, OCI, a separate component of shareholders' equity. It stays in OCI until the period when the hedged transaction actually affects earnings. All right.
For example, when the forecasted sale occurs or when the variable interest expense is recognized. Then, the amount is reclassified from OCI into earnings to offset the impact of the hedged item. It smooths earnings over time.
OCI, okay. And the third type.
The third type is a hedge of a net investment in a foreign operation. This uses a derivative, or sometimes non-derivative financial instruments, to hedge the currency risk associated with the company's overall investment in a foreign subsidiary. Similar to cash flow hedges, the effective portion of the gain or loss on this type of hedge is also reported in OCI.
Okay, hedge accounting helps match gains and losses but requires careful setup. Finally, let's touch on the lease landscape, accounting for usage. How does accounting handle leases?
Leasing is a common way for companies to acquire the right to use assets without buying them outright. The accounting, especially under recent standards, ASC 842, has become more complex, particularly for the lessee, the user of the asset.
Let's start with the lessor, the one providing the asset. How do they classify leases?
From the lessor's perspective, leases are generally classified into a few types. A key distinction is whether the lease effectively transfers control of the underlying asset to the lessee. If it does, meeting criteria similar to a sale, it's typically classified as a sales-type lease.
And the lessor recognizes profit upfront.
Yes, with a sales-type lease, the lessor de-recognizes the asset, records a lease receivable, and recognizes selling profit or loss at the commencement of the lease, just like a sale.
What if it doesn't transfer control?
If it doesn't transfer control but still meets certain criteria, like the present value of lease payments covering substantially all the asset's fair value, it might be a direct financing lease. Here, the lessor de-recognizes the asset and records a receivable but defers any profit recognition, recognizing interest income over the lease term instead. If neither of those classifications apply, it's an operating lease, where the lessor keeps the asset on its books and recognizes lease income over time.
Okay, different types for the lessor. What about sale-leaseback deals, where you sell an asset and then immediately lease it back?
Sale-leasebacks require careful scrutiny under the new rules. The first question is, does the initial sale part of the transaction actually qualify as a sale under the revenue recognition principles, ASC 606? Does control truly transfer to the buyer-lessor?
And if it does qualify as a sale?
If it qualifies as a sale, the seller-lessee de-recognizes the asset, recognizes the gain or loss on the sale, adjusted for the retained right of use, and then accounts for the leaseback portion like any other lease, typically recognizing a right of use ROU asset and a lease liability. The Billings Combat Equipment example demonstrated this.
And if the sale doesn't qualify, if control didn't really transfer?
Then the transaction is treated as a financing arrangement, not a sale. The seller-lessee keeps the asset on its books and continues to depreciate it. Any sale proceeds received are treated essentially as a loan from the buyer-lessor, recorded as a financial liability. It's a subtle but crucial distinction based on whether control actually transferred.
Again, substance over form seems key in advanced accounting,
It truly is.
beyond the commercial governmental accounting.
All right, for our final segment, let's step into what feels like a completely different financial universe. Beyond the commercial governmental accounting, you hinted earlier that governments play by their own rules.
They really do. It's a whole different ballgame. You might think accounting is accounting, but governmental entities, states, cities, counties, school districts operate under a unique set of standards, primarily set by the Governmental Accounting Standards Board, or GASB.
GASB, not FASB, Financial Accounting Standards Board, which sets rules for businesses.
Correct. And their focus is different too. Governmental accounting emphasizes accountability, specifically two types. Fiscal accountability, ensuring the government complied with public decisions concerning the raising and spending of public funds, especially within budgetary limitations. Operational accountability, measuring how efficiently and effectively the government used its resources in meeting its service objectives.
Accountability is the watchword. How does this difference play out in practice?
One of the biggest differences is the use of fund accounting. Governments organize their activities into separate funds, each acting like a self-balancing set of accounts. And the accounting within many of these funds is unique.
Particularly the governmental funds. You mentioned GRAS SPP.
Exactly. The main governmental funds, the general fund, special revenue funds, capital projects funds, debt service funds, and permanent funds, GRAS PP is a helpful mnemonic, use a basis of accounting called modified accrual.
Modified accrual, not full accrual like businesses.
Right. Modified accrual has some key differences. It focuses on current financial resources, essentially, cash and assets expected to be converted to cash soon. Revenues are recognized when they become both measurable and available to finance expenditures of the current period.
Available, that sounds different.
It is. It generally means collected within the current period or soon enough thereafter, often 60 days, to pay current liabilities. Expenditures, rather than expenses, are generally recognized when the related liability is incurred.
Okay. What else is different in these governmental funds?
Because of the focus on current financial resources, things like long-term assets, buildings, equipment often called capital assets, are not capitalized as assets on the governmental fund's balance sheet. Their purchase is treated as an expenditure when acquired.
Wow, so no fixed assets on the fund books.
Not on the governmental fund books. Similarly, long-term debt, like bonds issued to build a school, is not recorded as a liability in the governmental fund that receives the proceeds. Instead, the cash received from issuing the debt is recorded as an other financing source on the fund's operating statement.
That's radically different from business accounting.
It really is. It gives a very different picture, focused on near-term inflows and outflows.
But aren't there other types of funds in government? You mentioned proprietary funds.
Yes. Governments also have proprietary funds, which are used for activities that are run more like commercial businesses. There are two main types. Enterprise funds, used for activities that provide goods or services to the public on a user charge basis, like a city water utility, electric utility, or public golf course. Internal service funds, used for activities that provide goods or services to other departments within the same government on a cost reimbursement basis, like a central motor pool or IT services department.
And these are more business-like.
Much more. Proprietary funds, and also fiduciary funds, which hold assets for others, use full accrual accounting, just like commercial businesses. They focus on the flow of economic resources, meaning they do capitalize fixed assets, record depreciation expense, and show long-term debt as liabilities on their fund financial statements. Their statements look much more familiar to someone used to business accounting.
Okay, so different funds, different accounting bases. What about revenue recognition in government? Especially things like taxes.
Revenue recognition can be complex, particularly for non-exchange transactions where the government receives value without directly giving equal value in return. Taxes and certain grants are prime examples.
How are they recognized under modified accrual?
For property taxes and governmental funds, revenue is recognized in the period for which the taxes are levied, provided they are also available. For income taxes or sales taxes, revenue is recognized when the underlying transaction occurs. Income earned, sale made, again, subject to the availability criterion. Grants often have specific eligibility requirements, like purpose or time restrictions, that must be met before revenue can be recognized. It's quite rules-based.
Okay. And expenditures, how are they tracked?
Expenditures in governmental funds are meticulously classified, usually by multiple categories simultaneously. Common classifications include function, broad purpose, like public safety or health and welfare, program, specific activities within a function, organization unit, department responsible, activity, character, current operating, capital outlay, debt service, object, the specific thing purchased, like personnel services, supplies, contractual services. This detailed classification provides transparency and helps citizens and oversight bodies track exactly where public money is being spent.
That brings up budgetary control. How do governments keep from overspending their appropriations? You mentioned encumbrance accounting.
Yes, encumbrance accounting is a unique and critical budgetary control mechanism used only in governmental funds. When a government issues a purchase order or signs a contract, it creates an encumbrance.
Is that an expenditure?
No, importantly, an encumbrance is not a gap expenditure or a liability because the goods or services haven't been received yet. It's purely a budgetary entry. It records a commitment against the appropriation, essentially earmarking or reserving a portion of the fund balance
Why do they do that?
to prevent overspending. By recording encumbrances, the government reduces the amount of appropriation available for other commitments, ensuring it doesn't accidentally commit more resources than it has legally been authorized to spend by the legislative body, like the city council or state legislature. It's a powerful internal check built into the accounting system.
Very clever. Do governments have things like unusual or infrequent items?
Yes, they do. GASB defines special items as transactions or events that are within the control of management, but are either unusual in nature or infrequent in occurrence. Proceeds from the sale of a significant government building might be a special item.
And extraordinary items.
Extraordinary items are events that are both unusual in nature and infrequent in occurrence. Think major natural disasters like earthquakes or floods causing widespread damage. These are reported separately after special items.
Got it. You also mentioned deferred inflows and outflows. That sounds unique.
It is unique to governmental accounting. Deferred outflows of resources represent a consumption of net assets by the government that applies to a future period, conceptually similar to a prepaid expense or asset. Deferred inflows of resources represent an acquisition of net assets that applies to a future period, conceptually similar to unearned revenue or a liability.
Where do these come from?
They arise from various specific transactions defined by GSB, including certain changes in pension liability assumptions, specific types of grants received before time requirements are met, and some derivative hedging activities. They essentially act as reconciliation items between the fund statements and the government-wide statements, helping to properly allocate resource flows across time under the different accounting bases.
Speaking of government-wide statements,
Yeah.
you said the individual funds have their own statements, but there's also a bigger picture view.
Yes. While the fund financial statements provide detailed views of specific activities using their respective accounting bases, modified accrual for governmental funds, full accrual for proprietary, governments must also prepare government-wide financial statements.
And what's their purpose?
These provide a consolidated overall picture of the government's financial position and results of operations presented on a full accrual basis, similar to a business. They focus on that operational accountability aspect we talked about earlier.
So these statements show capital assets and long-term debt.
Exactly. On the government-wide statement of net position, like a balance sheet, and statement of activities, like an income statement, capital assets are reported and depreciated, and long-term debt is shown as a liability. This gives citizens and other stakeholders a much more comprehensive economic view of the government as a whole, transcending the individual fund structures.
And these are part of a bigger report, the ACFR.
Right. The basic financial statements, fund statements, and government-wide statements are typically presented within a larger document called the Annual Comprehensive Financial Report, ACFR, formerly known as the CFR.
What else is in the ACFR?
The ACFR goes much deeper. It includes an introductory section, the financial section, with auditor's report, management's discussion and analysis, or MD&A, the basic statements, notes, and required supplementary information, or RSI, and often a statistical section. The MD&A is particularly important. It's management's narrative overview and analysis of the government's financial performance. RSI includes crucial details like pension funding schedules and, for governments using the modified approach, information about infrastructure assets.
What's this modified approach for infrastructure?
That's another unique GASB option. For certain eligible infrastructure assets like roads, bridges, tunnels, assets that are part of a network and can be preserved for a very long time, governments can elect not to record depreciation expense on them.
No depreciation. How?
They can do this provided they meet strict criteria. They must have an up-to-date inventory of the assets, perform regular condition assessments, estimate the annual amount needed to maintain and preserve the assets at a specific condition level disclosed by the government, and document that they are actually spending approximately that amount each year. If they meet all these asset management requirements, they expense preservation costs as incurred instead of recording depreciation. It's an alternative way to show accountability for these long-lived public assets.
Interesting alternative. How do governments handle organizations that are related to them but legally separate, like a university foundation?
Those are called component units. These are legally separate organizations for which the primary government, like the city or state, is financially accountable. There are specific criteria for determining financial accountability.
And how are they shown in the financial statements?
Component units can either be blended, meaning their financial information is integrated directly into the primary government's appropriate funds as if they were part of the primary government. This is rare, usually only if they're substantively the same. Or, more commonly, they are discretely presented. This means their financial information is shown in separate columns in the government-wide financial statements, highlighting their separate legal status while still showing the primary government's accountability for them.
Okay, separate columns. It seems like a lot to keep straight with these two different accounting systems, modified accrual in the funds, full accrual government-wide. How do they connect?
There's a crucial reconciliation. The financial statements must include detailed schedules that reconcile the information presented in the governmental fund statements, modified accrual, current resources focus, to the information in the government-wide statements, full accrual economic resources focus.
What kinds of things are reconciled?
Key reconciling items include adding capital assets acquired during the year, which were expenditures in the funds, adding long-term debt issued, which was another financing source in the funds, subtracting principal payments on long-term debt, expenditures in the funds, recognizing depreciation expense, not recorded in the funds, and adjusting revenues to the full accrual basis, recognizing unavailable revenues. It's the accounting magic that bridges the gap between the two different perspectives, giving users a way to understand how they relate.
That reconciliation seems absolutely essential to understanding the full picture.
It really is. It ties the whole complex system together. Outro.
Wow, what an incredible deep dive. Seriously, we've covered so much ground today, from the foundational ways businesses think about creating value and managing risk,
The bedrock stuff.
to the complex financial instruments they use, like derivatives and leases,
Yeah.
all the way to the truly unique and frankly fascinating world of governmental accounting. My head is spinning a little, but in a good way.
It's incredible, isn't it, how all these seemingly disparate pieces of information, risk management, market dynamics, valuation, cost accounting, government rules, when you connect them, they give you a truly comprehensive understanding of how organizations actually operate,
Yeah.
how they make decisions, manage their financial health. You now have the knowledge, really, to see beyond the surface headlines and grasp the interconnectedness of strategy, finance, and day-to-day operations in a way you might not have before.
You've definitely given us a fantastic head start on truly understanding this intricate dance of value creation and risk management. I know I'm already thinking about my next coffee purchase, or even how my city manages its budget completely differently.
That's great. So, what does this all mean for you, the listener? Consider a business or organization you interact with regularly. Maybe it's your own workplace, a favorite local shop you visit, or even your city or county government. How might these concepts we've discussed, from differing risk preferences and leadership to the complexities of their capital structure, or how market forces influence their prices, or even how they measure performance beyond just profit, how might these be playing out behind the scenes right there?
Yeah, what new connection or insight really stands out to you right now based on what we've covered?
It's worth pondering. What patterns can you now see?
Keep that curiosity burning. This deep dive, as always, is truly just the beginning of your journey to becoming incredibly well-informed. We can't wait to see what you discover next.